Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome to the Australian Property Podcast. This is our Property Foundations mini-series with me, Pete Wargent, and buyer's agent, Amy Lunardi. In this mini-series, we're covering some of the basics of the property purchase process, the property myths, those things you shouldn't believe but probably do, the things we wish we'd known before we bought, and how to carry out a property inspection like a pro. And of course, our step-by-step guide to buying a property. We hope you enjoy the series. G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Amy Lunardi. Amy, it's great to have you back.
Always good, Pete. Always good to be back, especially after a long hiatus. I'm feeling fresh.
Good. I'm glad you are. So today we're going to talk about property myths, things you shouldn't believe but probably do about the property market. So let's see how many we can crack through today in this episode, Amy. So let's start with the first one. It's funny. There's this sort of kind of general sense that property markets always go up. I think, often on social media, I get people making sarcastic comments about, property always doubles every decade. Or property always, people always taking the mickey. But I suppose it is kind of a commonly held belief, isn't it, that the property markets always do tend to perform or go up over the long term.
And it exists for a reason, in that the long-term average in Australia is up. If we have a look at a graph from a macro scale, and that is taking all of the properties over all of Australia for, say, the last 40 plus years, it is up. So as a generalization, it's actually kind of true. But of course, we can never generalize, because we're not buying the whole market of Australia, are we? We're buying one, maybe a couple of properties. So we always have to bear in mind that property works on a macro and a micro level. And there are so many sub-markets in Australia which can not only not go up, but they can go down if you buy the wrong property. And I've seen properties which have even lost value despite the entire macro market rising over time. So we always need to remember that there are sub-markets and there are micro and macro factors that influence long-term growth. Pete, what are some of the more macro levels influences on capital growth that we have to be mindful of?
Well, yeah, a lot of these myths would be based around some form of basic truth, I suppose. I think if you look at why do prices go up, well, why does the price of anything go up? We live in an inflationary economy generally in Australia, and I think if you're looking at property prices, there's two different components. There's the land price, and then there's the cost of buildings as well. So I guess we've got a construction cost index that goes back over 60 years, and contrary to what you might think, it basically never goes down. The cost of construction has always gone up. It's gone up phenomenally over the past 4 years. And that's partly because the cost of labour tends to go up a lot. The construction industry is heavily unionised in Australia, so the labour costs tend to go up over time. I think also the product that people demand has changed an awful lot. If you went back 5 or 6 decades ago, well, a lot of the housing that was built in Queensland, they were pretty much shacks really, but the modern housing is very different by comparison. But also you've got the land values. I think I've done some research before looking at blocks of land in Sydney that sold around about 100 years ago, maybe on the northern beaches, for example. And with the population of Australia has increased dramatically over that time. I suppose the wealth of the country has increased dramatically. So people have more money. I saw Australian household wealth is 17 trillion this year. I mean, it was about 6 trillion in 2009. So people just have more wealth over time. And as the population grows in the landlocked areas that are very desirable, well, there's over 100 years of figures in Sydney to show that land prices in a lot of those for example, Northern Beaches suburbs would have done at least 10% per annum, if not more, maybe 11% per annum over 100 years. So when people say property markets always go up, well, it kind of is true in nominal terms and over the long term that a lot of those landlocked areas would do very well. But also, of course, the cost of everything else goes up too. So you want to ideally be investing in assets that go up faster than inflation.
Yeah, absolutely. And I like to think about things on a more macro and micro level too, because the macro stuff is so beyond your control. As an investor, we're talking about what's happening in the broader economy, interest rates, what's happening overseas, overall supply and demand, construction costs, like you just mentioned. So these big things, which sometimes change slowly over time, but sometimes we do have shocks as well. And in the last 15 years, for example, we had the global financial crisis. We had that real slowdown pre-election just before 2019 because we had the threat of negative gearing being taken away from us. We had COVID, obviously, and then more recently we've had the substantial interest rate rises too. And those are big, gigantic economic things which have impacted the broader economy. They've impacted different cities slightly differently. But then we've got the more micro level too as well. And this is a little bit more within our control when we're thinking about how to insulate our property and get the best asset, which will outperform other properties despite what's happening in prices on the broader macro level. And these are things like suburb selection, dwelling selection, street selection, floor plan. We can go right down to, understanding really what's the key drivers of growth within this suburb, what are the type of people wanting, etc. And that is a bit more within your control, not completely, because demographics and other things do change over time, especially if we're looking 10 to 15 years ahead. But I think the real issue with this myth is that if you're buying a property, first of all, just for the sake of it, to get into the property ladder, and relying on it growing in value to achieve your long-term goals, that's really risky. Buying something for the sake of it, if it's not a great asset or not a great investment, doesn't align with your cash flows or goals, you're forced to sell it soon, or maybe you sell at a loss in the future. If that then puts you back with your next purchase, and I have this quite often with first home buyers who say, I'm going to buy an investment property so that in 5 years I can sell it and use that profit to buy my home. Well, that's not a guarantee. And if you're reliant on that profit and you're not actively, first of all, considering the type of asset you're buying, but then not relying on other forms of, improving your borrowing capacity or increasing your savings, and you're only relying on that property growing in value, that's a very risky strategy, just because you think that the market will go up regardless in the long term. So it can be a bit of a dangerous myth. It's got some truth to it, but certainly not in all cases.
It's an interesting point you made there, from the macro to the micro, because the macro level, there's been some countries in the global financial crisis where countries that didn't have control of their own currency or their own interest rates, so some of the markets got really walloped. US market, I think, fell around 20%, but has since come absolutely roaring back since 2009. So, I guess time has been a great healer there. But I think in Australia, CoreLogic does a pain and gain report, and it shows what percentage of properties sell at a loss, an actual nominal loss from the purchase price to the sale. I think often, statistically, it's often when people buy brand new properties, off the plan properties, the loss rates or loss on resale is much higher statistically on those types of properties. I think sometimes if people are buying speculative bubbles in regional towns or mining towns, there's been plenty of losses there. And as you said, there's market cycles anyway. I think Australian property markets had numerous downturns over the past couple of decades, Banking World Commission, global financial crisis. There's been quite a few, and there's been a couple of big credit squeezes along the way. I think the asset selection's important, but also a bit of a wider view of what's going on at the macro level too.
Well, that leads us into the next myth, which is you can get rich quick in property. And I think that, again, this is one of those myths that you might have a bit of truth in, because you might know someone, or you might have read about someone, or especially if you buy these property magazines. Do people still buy property magazines, Pete? I used to get all of them. I don't know if they exist
Mostly
anymore.
online,
but
I think. Yeah.
Or you would have heard this story, or maybe someone's trying to sell you something, a course or whatever, to say you can get rich quick. And yes, absolutely, there are plenty of people who have managed to make a significant profit in a short period of time with property, because either they've been lucky, they've been in the right time at the right place, maybe they bought at the bottom of the market and without knowing that it was the bottom, and all of a sudden they've had a significant amount of growth. Maybe they have been really skilled in seeing opportunities for property development or rezoning opportunities, or buying a bargain, getting lucky and buying a bargain property off market and flipping it, or being really clever with renovations. So yes, there is opportunities, but at the same time, the percentage of these versus the percentage of other purchase, I would say, is relatively low, because with property, there are so many extra costs we have to consider. We've got stamp duty, we've got holding costs, and especially with things like renovations or property developments, there is a lot of risk with unknown costs, spending more than you plan on doing, spending more than you need to, making mistakes. And you can find yourself in an instance where not only have you made money, but you've actually lost money because you didn't go into it prepared enough. So yes, there are some situations where you can make money. I find that it's a combination of luck sometimes too, because I've seen case studies where someone said, I made $200,000 over 2 years because I renovated this property. And I say, well, but the market's gone up X percentage over those 2 years. If you'd actually done nothing to that property, you still would have made almost as much without the time and hassle. So we often forget to factor in market movement in itself, in other words, doing nothing, and also the opportunity cost, which is what the cost of your time doing something else, or your money being invested elsewhere as well. So many layers we have to consider there, Pete.
The Brits might remember there was an old Pommy TV show with a presenter called Sarah Beanie. She's a reno expert in England, and the number of times they do a show where somebody would buy, I don't know, a block of units in Brighton or something. They'd spend hours and weeks and months on renos, and at the end of the process, you would say, right, you made 30% on the project, and the market's gone up 31. Like it was almost every week. So I think, as you said, look, a lot of these myths have a grain of truth in them, and there's no question that in real estate, if for example you understand a big infrastructure project, like let's say for example Western Sydney Airport, if you got in ahead of time there and got some well located blocks of land, or maybe some paddocks which could be subdivided into multiple blocks. Look, there's definitely instances where people have made lots of money and really quickly, and it's not always luck either. Sometimes people have inside information or very skillful at doing the research. But yeah, I would say for the average person, you may get lucky once, and sometimes the same is true with property development projects. As you said, sometimes you just get the timing right and the market gives you a massive tailwind. But for most people, what are they trying to do in real estate? They're trying to build long-term sustainable wealth using compounding. And sometimes some of these sort of get rich quick ideas where you're flipping or options or trying to time the market here and there, like with the transaction costs, the capital gains taxes, you often find that people do take 2 steps forward and 3 steps back. So yeah, I think it's definitely possible. And but for a lot of us, actually, the real power is in the long term and the compounding.
Absolutely. And that leads us into the next myth, in that to say that renovations are always worthwhile. Renovations will always add value. And Owen and I did an episode, gosh, it must have been maybe 2022 now, a while ago, to talk about adding, 2023. I'm so ahead of myself here, Pete. But we talked about all of the ways that you can add value and the pros and cons and all of the different strategies. So go back and listen to that one if you are considering doing a renovation at some point in the future, or the pros and cons of it. But I think with this one, you always have to come back to say, well, what are you trying to achieve here with your renovation? And this is particularly relevant when we're talking about an investment property versus a home, because with a home, a renovation is generally going to be because you need or you want to change that property in a way to suit your own lifestyle better. So it might be upgrading the bathroom, adding an extension, adding a garage, whatever it might be, just making it more comfortable. And then the overarching goal is to achieve what you're wanting to get out of that renovation. That's really it. And then try and do it as cost effective as you can if that's relevant to you. I often hear this word overcapitalizing. Don't overcapitalize with a renovation. But I say, well, if you're going to be moving into a home and you're planning on being there for 10, 15, 20 years or longer, don't worry about that so much at the very start. Yes, be cost conscious and don't go crazy. However, don't stress so much about that, because your goal is to create a property that fulfills your owner-occupier goals. Versus if you're an investor, you have to be a lot more strategic with your renovation costs. If you're buying an investment, you're renovating it straight away. Well, why are you doing that? Is it because the property needs a renovation? You have to bring it up to code? Is it because you want to achieve a higher rent? And in which case you have to do the cost benefit analysis of how much more rent am I going to get? How much better quality tenant am I going to get versus how much is this renovation going to cost me in the long term? Or you might say, well, this doesn't make sense. I'm going to renovate it in the future just before I sell, because otherwise I'm doing a fancy new reno now, and that's going to be having quite a bit of wear and tear from that tenant in the longer run. So from an investment perspective, it's not always worthwhile doing. And when you're selling a property as well, you don't always have to renovate it to get the best price, because when you're spending money to sell a property, if you spend $1, well, of course you're going to want to at least make $1 back. And it's certainly not a guarantee. And that's why you have to be careful about not spending money on things which a buyer isn't going to value themselves. So Owen and I talked about this so much in the previous episode, but the long and short of it is that renovations absolutely aren't always worthwhile, especially if you go into it completely blind and you haven't done your research prior with costs and demographics and goals and cost benefit analysis, really.
Well, a bit of it goes back to what I was talking about before with the proliferation of those renovation shows. And I was definitely there's been various times in cycles where sometimes rundown properties almost sell for more. I think people say they see a renovator opportunity in a bull market, and people are like, "Oh, I'm going to buy a renovator," and you find there's that much competition for the property that there's no profit in the renovation, because it's all been arbitraged away by the extra buyers. And I think a lot of people fancy themselves as renovators and they don't necessarily budget all that well. I think
especially if you're doing, Pete, if you're doing a renovation which is the future buyer doesn't value that renovation because it's not to their taste, you might be better off just sprucing something up and making sure it's comfortable and fixing any obvious issues, rather than trying to sell to a buyer that appreciates what you like in a renovation and your type of kitchen and a bathroom. And build costs do come into play. I've found in Melbourne over the last, since COVID, since build costs have been really high, a lot of buyers have actually been leaning towards stuff that doesn't need as much work because they were worried about tradies and build costs and the unknown. So you've got to understand the market that you're buying into as well and what those buyers want.
Well, this is all quite timely. Yeah, I think you're right. The difference often is between, is this an investment or a home? So we've got a place, a home that we live in when we're in England, and it's not in a high capital growth area. And we're just going through, I can even open the spreadsheet for you right now, like some of the costs, because we need to add an extra double bedroom and an ensuite, and the drive needs doing, the property needs rendering, needs rewiring. We're looking at this saying this is a case of potentially overcapitalizing because it's not in an area where we'll necessarily recoup all those costs. But then not everything in life is, as you said, purely financial. We might put in a new kitchen and bathroom. Maybe we don't add that much value, but it's a bit like I'm also due for a car upgrade at the moment. Now, I want to buy a Jaguar. I think probably a smarter financial decision would be to get a Toyota, but not everything in life.
Not everything has to be logically
purely financial. They always used to say that for a Renault, if you spend $1, you want to add $1.50 or $2 of value. But as you said,
that's a myth, isn't it, Pete?
Isn't it just? Yeah,
just a silly benchmark.
With the way the Renault costs have gone up as well of late, that's definitely not always the case. I mean, you may find with an investment property, you get some depreciation benefits, but you also have to think if you do a renovation now, you might need to do another renovation as tastes change 5 or 10 years down the track. You've got wear and tear to worry about.
I've got big white subway in the renovation I did in my apartment 7 years ago. I've got those big white subway tires with black grout. It was very on trend at the time, not so much in 2025.
So, it comes back to what are you trying to achieve? Amy, let's talk a bit about the functionality of the market. Now, you're a highly experienced buyer's agent, so you know all about this kind of thing. So there's a few myths we want to talk about in terms of how the property process works in terms of buying and selling, when the best time to sell might be, how agents look at different bids and offers and so on. So there's a few myths here we're going to run through. So firstly, agents always sell to the highest bidder. You would think logically that would be the case, but not necessarily.
So much in property is about price, and so much in property is not about price. I know that sounds a little bit conflicting, but it is the truth, because in the real estate world, sometimes terms and sometimes other factors when it comes to selling a property mean more to someone than the price that they're going to sell it for. And I've had many instances over the years where I've purchased a property for a client at a lower price because we had better terms and conditions, or sometimes we have actually had to pay a premium because we needed certain other terms in that contract, which were non-negotiable for us, but that weakened our offer. And therefore, we did actually have to pay more. And we make decisions at that point in time about what's appropriate and whether it's worth paying a slight premium to have protection, for example, for a finance clause or a longer settlement or whatever else we needed. But this is why it's important that you have a really, well, not one, but many thorough discussions with the real estate agent right from the very beginning when you're first engaging them, right throughout the negotiation process, to figure out what could potentially make your offer more competitive, whether this is settlement terms, whether this is not having a finance clause or a building inspection clause, essentially having an unconditional contract, and obviously have a little asterisk against there to say never do that if you're not in a position where you can do that or if it's too risky. But even being really creative, over the years I've done things like rent back options for the vendor because they hadn't purchased a property yet, and then they didn't have to worry about renting. So we said you could live in that property for up to 6 months after settlement or whatever it was. And that was so incredibly appealing for them, more so than the ultimate price we offered as well. So these things you can get creative with. I've had floating settlements before, which is where I said, okay, settlement is on X date, but the vendor has exclusive discretion to bring that settlement forward. If they buy something else, they just have to give us X days notice. So just sometimes think outside the box. If you don't ask as well, you don't get. And bear in mind too that sometimes the agents don't think about these things. So it can be up to you. But further to that as well, and this sounds terrible, but I would say it actually does happen, in that sometimes the agent will actually sell something or skew the vendor towards selling something to someone because maybe that agent has an incentive because they want to sell that buyer's property. So they know if they sell it to that person, they might get their listing. Or in some cases as well, it's because the agent and the vendor prefer to deal with one buyer because they've been much more straightforward and less negative about the property, and they haven't got a bunch of extra terms and conditions, or they haven't been difficult. And I know that sounds silly, but it absolutely happens. It absolutely happens. So you need to be mindful of this in a negotiation. Yes, you can go hardball and you can be really ruthless, but it might bite you in the bum at some point in time, Pete.
You've covered that whole point beautifully, but yes, I think, that's right. If an agent is charging 2 or 3%, the price is not necessarily always the overriding factor. Sometimes a quick sale is better for the agent. So even though you would think that the highest bid always wins, it's not necessarily true. It might be true at an auction, but not necessarily at a private treaty sale.
Correct. Yeah, you're exactly right. So at an auction, you've got all of your terms and conditions pre-agreed to. Make sure you agree on them before the auction, Pete. Don't rock up and expect a 120-day settlement when the agent's only offered 60. Gosh. But with a private negotiation, absolutely terms and conditions come into play. And this is especially relevant if you ever find yourself in one of those best and highest one-offer situations where you might not have a chance to have a second crack at that property. You have to put forward your best price and best terms, and in which case you want to make sure that your terms and conditions are as appealing as possible.
Yeah, I don't know about long settlements, but I've definitely seen people win auctions and then be unsure as to whose name they're buying in or whether they should buy in a family trust. And it's like, you probably should know that stuff before you start bidding at an auction. Amy, this is a kind of a related point. I think sometimes there's a property myth that there's always room for negotiation, but negotiations aren't always back and forth. Sometimes in a really bullish market, well, there's no negotiation. You just got to be quick. Other times, well, it also depends on which market you're buying in. There's a different convention in different states. Some states will have an asking price. Other states will have maybe a guide price for an auction. So I think, it's a bit of a myth that you can always negotiate a certain percentage off an asking price, or that there's always room for negotiation, because sometimes there isn't.
This is probably one of the most grey areas when it comes to buying a property, is the negotiation process and also the sales process, because with an auction, there are very clear and defined rules that the agent and buyer has to adhere to. But with a private sale, it's basically whatever they want to do. Yes, there's a couple of very loose rules, but every agent can run a different sales process. Every agency might have a solid process that they have to do with every property, or it might be discretionary per agent. And maybe the agent will sell one property one way and another property the other way. And when I say different ways, for example, with a private scale, you could be in that best and highest situation, like I mentioned before, where you get one chance, or you could be in a best and highest situation where they'll say, okay, well, we'll deal with the top 3 buyers. Or they'll say, we'll come back to you once or twice. There's just so many variables. So it's up to you to establish the rules of the game at the very beginning with all of these things. Or it might be a more transparent process, which we would generally prefer. But with the negotiations, again, it's very grey. You can't go into a negotiation thinking, okay, well, there's going to be backwards and forwards here. That's how a negotiation works. Or if I've offered, if I'm going to come up 20 grand, the vendor has to come down 20 grand. Again, who says that? Why should they be doing that? Maybe they're already at their rock bottom and that's their take it or leave it price. And just because then you don't feel like they're being flexible, sometimes I find that buyers dig their heels into the ground, even though they would have paid that price. Well, now they're not going to, because the vendor's not negotiable. So you can't let your emotions overrule your rational decision-making with this. And sometimes I hear people say, always go in with a low ball offer and see what happens. Well, you can shoot yourself in the foot by doing that, because you might close that negotiation door straight away. So always think in a negotiation at the very beginning. My biggest tip is to say, okay, well, what's the maximum I'm going to consider paying for this property? What's my goal price? What's a bargain? And then just always come back to that later on. So, don't let the way that the negotiation's unfolding then influence that price you would have been prepared to pay earlier, just because the agent's being annoying or the vendor's not budging. And don't go into it with other people in your mind, in the back of your ear, like, tapping into Uncle Bob at the barbecue and him saying, go in 200 grand less, or do this or do that. Only you really know how that conversation and negotiation with that auction, with that agent has played out thus far. And that should really inform your strategy. And if you feel unsure about all of this, maybe consider getting professional help from a buyer's agent. Some buyer's agents like me offer a service where once a client's found a property, they just come to us and say, help me get it, do the due diligence, negotiate for me, just at that final end point as well. So that's an option for you too.
It's something we've talked in quite a lot of detail about in some earlier episodes too. So you can go back and listen to those, the tactics you can use when negotiating on a property. Amy, just to wrap up on today's episode, just looking at things from the other side, when you're coming to sell a property. So I just sold a place in Brisbane not so long ago. And I think, look, from one of the myths in the property market is that the spring selling season is the best time to sell. I think the logic goes something like this. Well, most people are looking for somewhere to buy in spring, and therefore, you should list your property in spring because there'll be the most buyers around. And that kind of makes some logical sense, like a lot of these myths. But I suppose it's not necessarily true. As it transpired in my case, the reason for selling was because I wanted the money to go and do something else, not least my renovation. But so the timing for me wasn't really about spring. It was just a personal circumstance. But there's also a curious logic here, because of course, if more people are listing their property at that time of year, especially in Sydney and Melbourne, that means you've got more competition as well. You've got other people auctioning properties every weekend. On a big weekend, there might be 1,500 auctions in Melbourne and 1,000 in Sydney. So I suppose, yes, it may be that spring is the best time to sell, but not necessarily.
That's right. And this also aligns with the question around when's the right time to buy. Because my answer is the same for both of these. And you probably know what I'm going to say, Pete, in that the best time to either sell or the best time to buy is the time that aligns with your own personal strategy. It's such a boring answer, isn't it? But it's the truth, because the only thing you can control is your own decision around when you do things. You can't control what's going to happen in the market. So if you wait 3, 6, 9 months because you think spring's a better time to sell or buy or whatever it is, and all of a sudden something happens in the market that influences prices up or down, then you could be in a worse position. And it then means that you might be, facing selling at a discount. But, the positive is then if you're going to buy, well, maybe you buy at a discount too. So as long as we buy and sell in the same market, that's important. But I would say as a couple of, final dot points here is the times when I would avoid selling is really around kind of Christmas time. So getting into December, I've always found that I buy for clients my biggest bargains because the buyers just seem to tune out towards the end of the year, and also avoiding much of January as well, because a lot of people are still checked out. People are on holidays. We've got Australia Day as well, which throws in another public holiday. So really kind of just avoiding that December, January period. As a buyer, though, you should be active in the market, still looking around that time, because sometimes you can snag a bargain or an early January sale. And then also just factoring into public holidays into a sales campaign. For example, in 2025, we've got Easter and Anzac Day quite close together. So if you were having a sale campaign, you just have to bear in mind that you might have a lot of people go away during those periods to public holiday weekends. You ideally wouldn't want an auction on. So lean on your agent, and also just bear in mind too that you could time it great and put a property online to sell, but then all of a sudden, and the market's great, but all of a sudden 4 other properties come up. They're exactly the same. And I had this happen to me when I sold at one of our townhouse developments earlier in the year. We put it on the internet. We thought, this is great time of year. Market's doing okay. And all of a sudden 3 other properties in the same price point, which were almost exactly the same, came online in the same week, beyond our control. And then the decision was, do we take it off? Do we move the auction? But if we move the auction, more properties could have come up. So you kind of just have to make a decision based on your own timeframes and stick with it, and then do your best with pricing and presentation and all those other things that are within your control.
I thought you were going to say for a moment the best time to buy was 20 years ago and the second best time is today.
Yeah, that too. I forgot about that, Pam.
Maybe
that's true.
Maybe that's another myth that we could throw in there. But you're definitely right on that that Christmas and January period. I think that's especially true in Queensland, where people go away for long periods over the summer break. And I've actually been to an auction Brisbane before, where I was more or less bidding against myself and the fence paling because nobody turned up. And perfectly good property, but everyone was away, and it was before Australia Day. So yeah, I think it may be that spring is a good time to sell for you, but not necessarily. It really depends on personal circumstances and what's going on in the market as well. So we'll finish it there for today. Hope you're enjoying the Foundation episodes. We'll leave links in the notes if you want to get in contact with Amy, active buyer's agent down in Melbourne. And as always, if you want to chat to me, there's a link in the notes as well. Amy, thanks very much for today, and looking forward to the rest of the Foundation series.
Always a pleasure, Pete. See you next time.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.